is happening in the high growth space? Stocks are getting smoked. First, it was all about re-rating. Now it is about de-rating. Where is the middle path? Is it goodbye to the so-called uh, growth stocks in the world, and the real collateral damage is now visible in some of the FANG stocks? I was looking at data in the morning that how a stock of Amazon, stock of the Amazon, is back to almost back to the pre-COVID levels. Rahul Bhasin joins us now, managing partner with Bearing Private Equity India, to walk us through what his thoughts are and why are we seeing such a sharpish adjustment in some of these internet and consumer tech companies. Rahul, when these stocks they went public, it was a shift of paradigm. Everyone thought that this is the new future. These are new companies which will change the way how we would be doing business and how earnings would and how these businesses will only grow. But now a complete reversal is happening. Hard questions are being asked on relevance, cash burn, and dilution.
Good morning to you and everyone else, all your viewers, Nikunj. Look, I've learned now that every time I've heard about a new investment paradigm or using new metrics or new jargon to explain how businesses should be valued, it typically doesn't end well. And I think that we went into one of those phases now. But before I sort of get into the correction phase, etc., I think we have to accept that technology. I think there are various models for investing in technology, and I think the most relevant one at this moment I would allude to is maybe the Gartner model, which talks about a trigger for innovation, and then a peak of inflated expectations is what happens. And I think what you saw was akin to that peak of inflated expectations. Then you have what they call the disillusionment, the trough of disillusionment, which is what you're seeing now with the market. And then after that, that's typically followed by what they call the slope of enlightenment, where, the technology, the trigger for innovation is obvious. I mean, you reach certain critical mass in technologies which actually facilitate a better product or service, which is of value. People get extremely carried away with what it can do. I mean, if you think about, for example, the entire cryptocurrencies in that whole era and that whole area, I mean, there are a lot of use cases which are extremely valuable, but they have been they have been ascribed value which is completely, I would say, in the zones of fantasy. I mean, just to give you an analogy, money in the game of Monopoly is very valuable for playing Monopoly, right? So a lot of tokens are very valuable for playing various kinds of games on the net, on the digital medium. But does that mean that Monopoly money is worth real money and many times real money? I mean, that's where we get sort of, where we lose the sight of reality, right? And not to say that the entire architecture and the breakthrough in terms of technology, which the entire blockchain sort of infrastructure, etc., represents, is not fundamental. It is fundamental, and you will get use cases and more use cases as with Web 3.0. But the valuations ascribed to it is just completely out of whack, and so you're seeing now, the trough of disillusionment. Then you'll get the slope of entitlement, which means that some of these use cases actually come through, and then that sort of, I would say that menu card of use cases will start to broaden. You will see slow pickup in those kinds of companies that actually deliver those use cases. And then you will sort of ultimately reach, what's called the plateau of productivity, where something will be widely adopted. It'll become, everyone will have it, and then increases in efficiency, etc. The incremental innovation, which typically takes place in every industry, doesn't add marginal utility to the customer, and then again you stop getting economic payoff for it. So you get investment returns if you invest right at the beginning. Then you have this sort of peak where you should be getting out, and now you're getting the trough of disillusionment with all of this. But let's accept one thing. Technology has changed the way we live, and it changed it very fundamentally, and it will continue to do so. But we are going through what I call a very needed correction zone at this moment in its life cycle.
I draw a parallel, which is the TMT boom and the bust. The number of companies which survived when the cycle reversed were less than 5%. Are we going to go through that change that it will be the fittest, survival of the fittest, but those who survive, they would be giant companies? Will we see the same happening?
Absolutely. And let me tell you the ones who will, are in trouble and will stay in trouble. And the ones which, and there, I think, certain common patterns of mistakes that people have made in this overexcitement and overexuberance in the tech space in the recent past. One is companies which have created augmented products, which are superior products, but beyond the means of the investor or the consumer or the customer to pay for them. And they have subsidized them, acquired a lot of customers on that superior product, but they're ahead of the customer's ability to pay for them. I mean, I've mentioned this before, I think, in different interviews, but there are only 10 million consumers in India who do more than 6 transactions on the net in a year. But you have so many businesses which are making out, which are building out for use cases of 50, 100, 200 million customers. Now, it will get there. I am 100% certain that we will get there. But if you build out infrastructure so much in advance and then you burn cash so much in advance, or you acquire customers who will bleed you for so many years, then your net present value of that to an investor is going to be very poor. And I think we're seeing one of those kinds of things. The other thing I would say is that companies which are doing more of the same, they're doing what other traditional companies are offering, but have been acquiring customers and showing very high growth because of discounting in many ways. And you're seeing this across sectors. I mean, you're seeing this. There's a lot of this in fintech which is taking place. So the utility to the customer or the consumer is not improving, but by discounting, you're acquiring customers. I think, again, we've seen this in gold loan companies. We've seen this in various kinds of where new age fintechs have got in and are offering effectively the same liquidity solution to customers, but doing it in a way where they are giving incremental logistics, etc., which have costs, not recovering those costs from the customer, burning a big hole, but growing fast. And this is just one example. I mean, there are plenty of these which are going around. The third is the inflection point of going from negative cash flow to positive cash flow, being very far out. Now, the issue is that when your cost of capital is 0, that works fine because your cash flow 20 years now is equal to your cash flow now, and people will be willing to take those bets. But as the long bond has sort of gone up in the US, which is, I would say, the benchmark for risk-free rate around the world, above 3%, suddenly one has to recalculate that. And the issue that happens when your cost of capital starts to go up after effectively 40-year secular decline, you just reverse and start going the other way. The problem is that now no one knows where this would end up in terms of the cost of capital. And therefore, suddenly positive cash flows, which are very far out, suddenly don't look that attractive anymore. And again, there's that revaluation. And lastly, there is also what I call the sheer execution inefficiencies in these kinds of companies would hurt too. But you will get, and I mean, if you look at the global markets, and I guess the fifth point I would make would be where regulators step in and put a cap on the economics of the businesses. You've seen that in a large way in China with Alibaba, Tencent, Didi, etc., getting hurt as a consequence. In India, you've had the payment companies getting disrupted because of NCPI and UPI. You're also now seeing the government taking initiatives in creating what they call the ONDC architecture to get on to retailing. So, you have to look at government actions and government intent also very closely in the tech space. But if you look at the large companies, you look at, say, an Alphabet, and you adopt the technology sort of evaluation metrics like the M score. The M score is nothing but if you take the enterprise value of the company and you see the 5 years cumulative R&D expenditure, that gives you the M score. It's very cheap. Alphabet is really, really cheap today, right? And sorry, Nikunj.
No, Rahul, please go ahead. I just wanted to, take that, your point forward in terms of how to look at companies and, separate the men from the boys per se. As you mentioned, a lot of these metrics may give you false indicators as well. So what's the right way? Because at some point, these companies do become valuable, right?
Well, that's what I'm saying. Some of these really strong companies are very attractive buys. I think that, a company like Alibaba, for example, in China today, and I'm, bringing in global examples because they're instructive from an Indian context. They have 800 million customers, 10 million sellers. There are only 2.5 million registered incorporated companies in India. They have 10 million sellers, and they don't charge a transaction fee. They only charge people for showing their goods or displaying their goods earlier when that person is scrolling down. How do you shake a business like that? And maybe there may be regulatory sort of pressures, but I think that fundamentally it's a very strong franchise, right? Similarly with Google, I mean, it's very tough to shake them, and Alphabet, which is the traded company. And there are lots of these companies which are extremely powerful. They have fantastic cash flows, and they're down between 30 and 50%, right? So, I think there's that area in that. I mean, how do you shake an Amazon? Look at the kind of franchise that they've built. And, if Amazon were to, raise their rates across the board by 2%, I don't think they'll lose any business. But, the bottom line, the operating leverage is just massive, right?
Yeah.
I mean, so there are these kinds of businesses which are extremely valuable, and they're giving good opportunities to investors to buy. And then there are the other kind which I delineated earlier.
Can't live without Amazon. You're right about that. But Rahul, would you liken the ongoing sell-off that we're seeing in a lot of the US-based tech companies to the kind of dot-com burst as well that we witnessed in the early 2000s? And what do you believe would be, some of the factors that could really change the dynamic when it comes to how we're viewing these stocks back home?
I think that we really need to apply that very basic methodology of saying, how do you get to cash flows? And I can understand, two-sided exchanges saying we're going to burn money because we're going to have, we need to build out the population set on both sides. And that will lead to an ecosystem where the traditional cost curves don't apply, and you have, effectively perpetually declining marginal cost of transactions. I can understand that use case for burning money. I can understand the use case of burning money, which is saying that this is my unit fixed cost. And once I cross this, I start generating, my contribution becomes positive and I start making money. But there are a lot of those other kinds of, situations that I described to you, which I think a lot of Indian tech companies are guilty of, where, they are hurting and they will continue to hurt. I don't, till they fix the stuff on the operating side, I don't see the capital markets being very kind to them.
Rahul, for sharing with us your outlook on the entire tech space as well as what we're seeing in terms of valuations in the global tech buzz.